Prepaid interest. Now, what is prepaid interest? That is going to refer to interest payments made in advance of the period in which the interest actually accrues. Now, according to tax regulations, prepaid interest is deductible in the tax year to which, and to the extent that, the interest is allocable as it accrues. This means that you can only deduct the interest expense in the tax year it relates to, and not in the year you actually paid it. So, generally speaking, cash basis, when money goes out the door, it's a deduction. When money comes in the door, it's income. But we've got different rules here. So let's say, for example, that John is a small business owner. John takes out a business loan of $50,000 for year one with an annual interest rate of 6%. The loan term is 5 years, and interest payments are due at the end of each year. However, John decides to prepay the interest for the entire loan term at the end of year one. Why would John do this? I don't know. Doesn't matter. John decided to do this. Now, what is the annual interest payment? The annual interest payment would be $50,000 times 0.06. That's the 6% interest rate. That's $3,000. Now, what is the total prepaid interest? That would be the annual interest payment times the loan term. So that's $3,000 times 5 years. Sounds good to me. That would give us $15,000. So in this case, John's going to prepay $15,000 of interest at the end of year one for the entire loan terms. I mean, the whole point of taking out debt is to extend your expenses and not have to pay it all up front. But John, do what you got to do. However, he can only deduct the interest that is allocable to each tax year as it accrues. This is the IRS basically trying to limit how much you can deduct. Gotta love it. This is them taking a stance against you. In some cases, they take your side, such as not forcing you to include income if you were injured, workers' comp, but in this case, they're limiting you. In this case, the annual interest payment is $3,000. As such, even though cash flowed out the door in year one in the form of a full $15,000, you can only, as John, deduct $3,000 each year. Now, this example is going to demonstrate that even though John had, and you would think normally that, okay, $15,000 went out the door, you can expense that all in year one. Nope. Even though you prepaid interest for the entire loan in year one, you can only deduct interest as it is allocable as it accrues. Now, I mean, there's legitimate reasons for this. It's not just the IRS giving you a low blow. Many reasons that people are, try to get one over on the IRS. So not to get into examples of that too much, but that's essentially what we're dealing with. Trying to make sure that everything's fair.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.